Hello students and welcome to the lecture. So students, as we know that we are covering the financial system and basically what we are doing the Indian banking system. Okay? And in the Indian banking system, basically what we are you can say covering, we are covering the generation of the banking. Generations of the banking. This is the topic what we are covering. Okay? And so far we had covered the first generation, which was pre-independence era. Okay, we had covered the second generation, which was the time period between 1947 till 1967. Thereafter, we had covered the third generation. The time period was between 1967 till 1991. Okay, so these are the generations. Okay, these are the time period: pre-independence era, 1947, 1967, 1967 to 1991. Got it? These are the generations. As we had discussed, the first generation did not having any particular time period, so that's why we haven't written it down here also. Okay, so these are the generations in which we had discussed about the past, we had connected it with the present, and even we had got an idea about the future, right? So these are the things we had done in the first generation, second generation, in the third generation. Right now, what we are left with, basically we are left with the fourth generation. Okay, we are left with the fourth generation. So now we are going to proceed with it. So let's start. Okay. So the fourth generation is having the time period between the 1991 to the 2014. Okay. So if we talk about the particular year of 1991, so what is the significance of the 1991 in that particular area? What is the significance of it? So 1991 is the year famously known for the new economic policy. Okay. Also we called it as a NEP. Okay, and the new economic policy, the nickname of it is the LPG. Okay, L for liberalization, privatization. Okay, and the last one is the globalization. Okay, so this is the year famously known for the new economic policy NEP and for this area. Okay, thereafter if we talk about the another year, which is the 2014. So what happened in the year of 2014? In this year, The planning commission was discontinued. Okay, and you can say the Niti Aayog was came into the picture. Okay, and Niti Aayog is having the full form like National Institute of, you can say National Institute National Institute for Transforming India. Okay, so this is the significance of these years. All right, so now I hope you have got an overview of this series before starting of the actual series. Okay, so let's begin. First of all is the background of the fourth generation. The period of fourth generation banking in India, spanning from the time period of 1991 to the 2014, was marked by the significant reforms aimed at modernizing the banking sector, enhancing efficiency, and promoting the competition. Okay, so basically, if we talk about the year of 1949, 1969, 1980, these all years are the years for which, for the year of nationalization, right? In which we had seen that total 20 major private banks were converted into the public banks, right? That's what we had seen during these phases. Okay, so this is the time period when the government had taken over the control over these private banks. Okay, to promote the financial inclusion. Okay, priority sector lending. All right, wider coverage. And you can say the main significance was class concentration to mass concentration, right? Okay, so that was the era. But what happened during this time? That is the main thing that we should see. So here you can see enhancing the efficiency and promoting the competition. Just keep this word in your mind. Okay, these reforms were initiated in response to the economic liberalization policies introduced in the 1991, which sought to open up the Indian economy to global markets and promote economic growth. Now it's a time to create the picture. Okay, before this nationalization, what was happening? There was an inclination towards a specific class. Okay, inclination towards, you can say towards an elite class. Towards an elite class. Okay, that was the actual scenario during that time. Got it? But when the government took over to promote the financial, you can say, inclusion, basically what they did, they put the restriction over the private ownership. Okay, the private banks which were operating that time, they were, you can say, discouraged by the government. And remember, the public sector banks were having only one approach. What was that approach? What was that approach? the approach was welfare approach. Okay, the public sector banks had the welfare approach. But when we talk about the private ownership banks, basically they had the profit maximization approach. Okay, so their approach were different. All right, in welfare approach there was almost no competition, and there were the losses also, as we had seen, because they were giving the you can say emphasize on the welfare approach. That's why they are charging the low interest rate on the loans, and even they are providing the high interest rate on the deposits. Okay, so there was a loss situation, and because these all banks were basically focusing on the welfare approach, so there were almost no competition in the market. But when we come to the private ownership, basically they were focusing on the profit maximization, which means they will charge a high interest rate on the loans, they will provide a low interest rate on the deposits. Okay, second, their only focus is for the profit, and that's why there are the competition approach. Okay, and remember, whenever there is a competition, the services will be customer centric. Okay, which means the customers will be benefited. So this is the background. Okay, however, the government took over the control of the banks and the financial institutions during the 1949, 1969 and 1980 in order to bring the equality, to bring the welfare in the market, which was you can say good at some extent. But as we passed the time, we realized that the elimination of competition, is not only you can say harmful from the customer point of view, because the services are not in a you can say in a good manner, but also because the options are limited. And whenever the options are limited, which means that the pressure on the few entities will be increased. Okay, so these are the main reasons, or you can say main issues of the fourth generation banking. Now, this is the key reforms. Like after introduce the LPG, or you can say the liberalization, the privatization, and the globalization. After introduction of this particular policy, what were the reforms we introduced in the economy? So let's start with the first one, is the issuance of the new licenses. One of the key reforms during this period was the issuance of the new licenses to the private and the foreign banks. This move was aimed at introducing competition in the banking sector, which was expected to improve the productivity and the efficiency, because as I had told you, the public sector banks, the public sector banks which were established by the government during the time periods, basically they had the no competition, okay, no customer centric services, all right, and basically they provided the limited options. Okay, so because of this, you can say, suppose if there are 10 banks in the market, for example, all these 10 are the public sector banks. Got it? Each of them having 10 crores capital to lend out as a loan. Okay, so 10, 10, 10. What will happen? Total ability of the credit is about rupees 100 crores. Okay, but suppose the economy is now in the condition that at least 20 crores is a bare minimum. So 200 crores is a bare minimum. This amount is required. Now, the options are limited. Why? Because only the public sector banks were allowed to operate in the market, which were 10 in number, and the other banks like the private banks and the public banks. Like the private banks and the, sorry, not public, these are the foreign. Corrected. Like the private banks and the foreign banks, these were not allowed to come in the market. It means that the entire burden of ensuring the credit facility in the economy is lies on these 10 banks. And even because of their welfare approach, as I had told you, they were giving a high on the deposits and were charging low on the you can say loans, or you can say on the credit facilities. So because of this, these were already suffering a losses. Now just imagine the condition. These banks were already in the loss, and even they were burdened because of this demand. Okay, and due to this, they had no customer centric approach, even in your daily times. Because as I had told you, we have to connect the past with the present, and the present will be connected to the future. So if we talk about this, then in your daily life or daily time, you have heard about that was a government bank. That was a services are not good. The government bank, low efficient bank. These type of statements, these types of words you have heard in your daily life. Okay, so that was the reason. They didn't have any customer centric approach because they didn't have any competition. Okay, and they provided the limited options in the market. So when the private banks and the foreign banks were you can say allowed during the phase of liberalization, privatization, and the globalization, which means that when the door of the Indian bankings were open for the private banks and the foreign banks once again. Why? Because prior to the nationalization phase, the private banks were already operating in the India. Before the independence, the foreign banks were also operating in India. Okay, so again they got chances to establish their businesses in the India, and that was to be facilitated by the issuance of the new licenses. Okay, this move was basically aimed to introduce the competition, which means that to enhance the customer centric approach. Okay, and second, improve the productivity and the efficiency. Why? Because now the people, instead of having the limited options, nowadays they will have the widespread option. Got it? So which means that once the foreign and the private banks were allowed, so they could also contribute in the demand, which means that this demand could be mutually met up by the public, private, and foreign banks instead of only by the public banks as earlier before the 1991. Got it? New licenses were basically available to them on the easy terms so that they could, you can say, easily launch their services into India. Leveraging technology. The fourth generation banking era saw a significant emphasis on the leveraging technology to enhance the banking services. This included the introduction of the internet banking, mobile banking, and the other electronic payment systems, making banking more convenient and accessible to the customers. Now, during this time period, that was also the fourth, or you can say 3.5 generation and beginning of fourth generation of the information technology, or not information technology exactly, but was the computer technology. Okay, the same time period in which the fourth generation banking was introduced was the same time period when the 3.5 generation and the fourth generation of the computer technology was also in the market. Okay, that was the reason why the technology, or you can say the leveraging technology, is become the part of this banking evolution. Because suppose, as we know, the computerization is basically needed for the effective, efficient, and fast banking needs. Okay, like if we talk about the present, if you having the cell phone, if you having a laptop, if you having any electronic item, you could easily use the UPI to make the payments. Okay, you could easily download the bank account or bank app in which you can check your accounts, you can check your passbook, you can check your transactions. All right, while sitting at your home, you could open your fixed deposit, recurring deposit, and so on. Okay, it means that now availing the banking services is not a hard task. Easily, you could do anything with your phone and mobile. All right, it is possible just because of computerization and the leveraging technology. So you can say, suppose if there are four banks, A, B, C, and D. These are the four banks. Because as I have told you, after putting up the restrictions of and restrictions against the entering of the foreign in the private banks, the banks privately of foreign, you can say originator of foreigners, they entered the market, which leads to the increasing numbers of banks. And when the banks increase, the options increase. So if you can say that these are the five banks basically. Okay, out of these five banks, A and E, they having the good leverage technology. It means that the customers who are get appointed with A and E will have a positive feedback regarding them. Okay, and that will also be reflected in the market, and more people will come to the A and E. All right, that was the reason. Like the in fourth generation banking era, mostly banks were trying to leverage the technology, or you can say to enhance the technology. Okay, and this could include the internet banking, the mobile banking, and the other electronic payment systems, which made the banking more convenient and accessible to the customers. Got it? Thereafter, introduction of the prudential norms. Prudential norms such as capital adequacy ratio and asset classification and provisioning norms were introduced to ensure the financial health and the stability of the banks. These norms aim to prevent the excessive risk taking and improve the overall risk management practices of the bank. Okay, so basically that was a time period when the CRR, the SLR, the MSF, all right, these things were introduced. Repo rate, reverse repo rate. Okay, you can say non-performing asset, all of these kind of classifications were also, you can say, presented for the first time during this time period. Okay, and as we had discussed these terms in the previous lectures already, these are basically done to protect the banks, to increase their efficiency, and to increase their to increase their efficiency and to increase their service capacity. Okay, so please remember these terms: operational flexibility and the functional autonomy. Banks were granted the operational flexibility and the functional autonomy to make their operations more efficient. This included the freedom to design the product, set interest rates, and manage their balance sheet in line with the market conditions. So please remember, during the 1969 and the 1980s, when the government was taking over the control of the banks, what was happening during that time? Basically, during that time, the government had assumed the overall control of the banks and its management. It means that the operational flexibility was not granted, even the functional autonomy was not even in the list. All right. So, what happened? Due to the inefficient management of the banks and its and their resources, you can say, we had to suffer a lot. Okay. So when we introduced the LPG policy, basically what we did, we focused on the operational flexibility and the functional autonomy. How the bank should run, what are the you can say operations the bank should carry on. All of these things should be decided by the banks, but should be in accordance with the rules and regulations set up by the Reserve Bank of India, so that we could ensure the integrity, fairness, and even the unity. Okay, but instead of controlling them, just provide them the control autonomy. Okay. Thereafter, we have the corporate governance practices. There was a focus on implementing the best corporate governance practices in banks to ensure the transparency, the accountability, and the integrity in their operations. This was seen as crucial for maintaining the trust of depositors and investors, because when the government, you can say, put back the restrictions and let the private players and the foreign banks entered into the market, the main aim was to provide the functional autonomy and, you can say, the operation flexibility, as we had just seen in the previous slide, but to ensure that they should be done in a transparent and a fair manner. Okay. Capital base fortification. Banks were required to fortify their capital base in accordance with the Basel norms. Basel norms we had already seen in the previous lectures basically, which are international standards for the banking supervision, was aimed at ensuring that banks had an adequate capital buffer to absorb losses and maintain financial stability. Because once you open up your economy, you are inviting the foreign players, even your banks are going to participate in the economy, which means that now you are a part of globalization. And when you are a part of the globalization, you require to operate as per the global or the international standards. Okay. Impact of reforms. These reforms introduced during the fourth generational banking era had several positive impacts on the banking sector and the economy as a whole. Like, first is increase the competition, leading to the improved efficiency and innovation in the banking services we had just discussed. Enhance the access to the banking services, especially in the rural and the undeserved areas, through the use of the technology. And strengthen the financial stability and risk management practices, making the banking sector more resilient and to the economic shocks. So these are the major impacts of the reforms introduced during this time period. Okay. If we made the conclusion of the fourth generational banking, we could say the period of the fourth generational banking in India was a transformative phase for the banking sector, characterized by the significant reforms aimed at modernizing the sector and enhancing its efficiency and the competitiveness. Okay. These reforms laid the foundation for a more robust and the dynamic banking sector, played a crucial role in supporting India's economic growth and development, because after seeing a failure, we made the changes. It means that we had found out the loopholes we were facing, and then we correct it. Okay, so that's why it's having a significant impact over the banking economy of the Indian country. Okay, so students, basically in this lecture we had finished the generations of the banking. In the next lecture we will begin with the banking sector development. Till then, just revise all the facts and figures we had discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture, and what we say thank you.